Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. April is Financial Literacy Month, and we will be covering a wide variety of topics to support the cause. Joining me is Caleb Silver, Editor-in-Chief at Investopedia, to discuss investing versus trading, a topic that endures all types of cycles. So, Caleb, let's start with what investing is and what trading is.
Sure. Great question. And people ask this all the time, and some people confuse it, especially those new to the market. But if you're an investor, you have a long-term plan. This is allocating funds with the expectation of generating a profit over the long term. Think about being a long distance runner, a marathon runner. Traders, on the other hand, they're looking for opportunities to make money within a day, within an hour, sometimes within minutes. They're more sprinters, and they're trading, looking to lock in short-term gains without that longer-term investment plan in mind. It's a different strategy, and they both require different sets of educational tools.
Right. And there's an important distinction to make between long-term investing versus day trading.
Sure. And folks think that it's the same thing all the time. And sometimes the financial media may make it a little confusing because they say the market traded up, the market traded down. Some of that is just investing, people buying and holding for the long term. And some of that is actually trading, where people literally are trying to make money by the second, by the minute. And it's sometimes a lot of machines doing that too with algorithmic trading. But the point for normal investors, retail investors, you have to decide, are you planning for the long term? Are you developing a strategy where you're buying index funds, stocks, mutual funds, et cetera, for the long-term gain? Or are you just trying to get in and out in a day trade, or trying to trade a particular stock, trying to make money when it goes up and when it goes down?
And if we take a look at what market timing is, it sounds like it might be challenging to actually do that.
Yeah, we always say that it's better to have time in the market than trying to time the market, because it's impossible to time the market. Nobody knows when the market's going to go up or down. Maybe some people think they do, but in general, it's really a function of our animal spirits as investors. So if you're trying to time the market, you're trying to time when to buy or sell your investments to maximize your profits or losses, but you're never going to find the top or the bottom. You're going to be somewhere in the middle, but you have to have the tools in place so you don't get burned either way.
And to wrap up here, you're an investor if you're doing this.
Yeah, if you're building that portfolio of assets for the growth over the long term, you're an investor. If you're relying on compound interest, the magic of compound interest, which makes investing so profitable and so fun, you're a long-term investor. If you're reinvesting your dividends and continually adding new positions or beefing up your existing positions in your portfolio, you're playing for the long term. And if you're balancing your portfolio a few times a year and playing the long game, you're an investor.
Caleb, thanks for joining us on Financial Literacy Month, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.